China just moved $8 trillion. $8 trillion. That's bigger than the annual output of Germany, bigger than Japan, bigger than the GDP of every country in Africa combined. And they didn't move it with one headline event. They moved it through a quiet, coordinated repositioning across reserves, foreign assets, trade settlement, and the plumbing of global finance. If that sounds boring, good. Because the most disruptive moves in history usually look boring right up until the moment the system feels the pressure, and everyone suddenly realizes the rules have changed. Now, two versions of this story are circulating online. Version 1 is clickbait doom. Western markets will definitely collapse on a specific date. That's not what I'm doing. Version 2 is pattern recognition. Watching how leverage accumulates, how alternatives get built, and how interdependence becomes a weapon when politics turn hostile. That second version is real. It's measurable. And if you're investing, running a business, or just trying to protect your future, it's the version you need to understand. Because there's a four-stage pattern that shows up again and again when a rising economic power challenges an established financial order. Different centuries, different flags, different technologies, same choreography, 4 stages, same sequence, same logic. And if you map the US-China relationship onto that sequence, we are not at stage 1 anymore. We are not even at stage 2. We are deep into stage 3, the quiet phase where the challenger builds exit ramps while the incumbent keeps living like the road goes on forever. Let me show you the pattern. Not the watered-down version they teach in a macro class, but the version you only see when you study power, trade, and financial plumbing at the same time. The 4-stage pattern every rising power follows. 4 stages, always the same sequence. And when it runs to completion, the ending is never gentle. Stage 1 is the foundation of dual dependency. 2 economic powers become intertwined. Trade flows explode. Capital flows normalize. Supply chains mesh. Everyone gets rich. Politicians give speeches about cooperation. Economists write papers about how conflict is irrational because the costs are too high. That sentence gets repeated in every era. We're too connected to fight. It always sounds smart. It always sounds modern. It is always the sentence people repeat right before the system breaks. Stage 2 is asymmetric accumulation. One side quietly stacks strategic advantages while the other side gets comfortable. Surplus nations build reserves, industrial depth, and optionality. Deficit nations build debt, fragility, and dependency. The shift is slow enough that it doesn't feel like a crisis. It feels like business as usual. And that's why it works. By the time the dominant power realizes the leverage has shifted, the leverage has already shifted. Stage 3 is strategic repositioning. This is the phase where the challenger keeps smiling in public and quietly rearranging the room behind the scenes. Diversifying reserves, building alternative payment rails, hardening supply chains, locking up commodities, signing currency deals, expanding influence in trade corridors. Stage 3 doesn't look like an attack. It looks like normal finance. It looks like risk management. It looks like nothing until you realize it's preparing for the day cooperation turns to coercion. Stage 4 is controlled demolition. If it gets that far, the challenger doesn't need to win a conventional war. They pull levers. They weaponize the dependency they spent decades building. They force financial pain to achieve political objectives, and the established power discovers that debt, consumption, and fragile supply chains are not armor. They are pressure points. How this pattern destroyed Britain and could destroy America. Let me show you this pattern in action. Britain and Germany in the early 1900s. Britain was the global superpower. London was the center of global finance. Sterling had enormous international reach. Britain looked permanent, like the system itself. Germany was rising fast, industrializing, expanding manufacturing, building strategic capacity. Stage 1 was there. Deep commercial ties, heavy trade. Elites convinced that commerce made conflict irrational. Newspapers talked about peace through trade. Politicians talked about partnership and permanent stability. Stage 2 was the quiet shift. The rising power builds strength while the dominant power enjoys the benefits of the existing order. In the pre-war years, European powers emphasize monetary resilience because when the system is stressed, trust becomes currency. The strategic logic is timeless. If you think a fracture is possible, you reduce exposure to your rival's rails and you build buffers that can survive a liquidity shock. Then stress hits. When conflict arrives, convertibility, capital mobility, and normal finance can vanish overnight. Markets don't politely adjust, they seize. The dominant power may still win battles, but the financial center of gravity can shift anyway because crises force new arrangements and new dependencies. The lesson isn't one move caused everything. The lesson is stage 1 creates dependency. Stage 2 shifts leverage. Stage 3 prepares the levers. And stage 4 is when the plumbing becomes a battleground. Where China stands in the pattern right now. Now bring this back to China. This is where the internet turns pattern recognition into prophecy. China moved 8 trillion. It's inevitable. Everyone will lose everything. That's the exaggerated version. The smarter version is China has spent decades building leverage, and in recent years, it has been building options. Options matter because they reduce vulnerability to sanctions, asset freezes, and Western financial rails. That is exactly what Stage 3 looks like. Stage 1 for the US and China, roughly 1990 to 2010. Integration. The world brought China into the global system. Supply chains moved, manufacturing moved, technology and know-how moved, corporate profits soared, consumers got cheap goods, China got growth, jobs, and capital. Everybody believed the relationship was permanent because everybody benefited. That's how Stage 1 always feels. Stage 2, roughly 2010 to 2020. Accumulation. China built very large foreign exchange reserves, expanded industrial depth across critical categories, and increased influence through infrastructure, finance, trade corridors, and regional supply networks. Whether you love or hate those initiatives is not the point. The point is leverage. When one country sits in the middle of your supply chains, and when it can influence settlement rails, commodity processing, and trade routes, that is leverage that can be turned into a lever. Stage 3, 2022, to present. Repositioning. This is where the headline writers lose the plot because Stage 3 looks boring. It's not tanks, it's spreadsheets. It's not a dramatic declaration. It's 1,000 small moves that add up to a changed system. China's Treasury reduction. Nobody wants to discuss. Start with US Treasuries. China has been reducing reported holdings over time. That doesn't mean there's a dump everything tomorrow button. It does mean shrinking one category of vulnerability. Heavy exposure to a rival's debt market in a world where sanctions and asset freezes are now normal tools of statecraft. China's holdings of US Treasuries fell to $682.6 billion in November 2025, down $6.1 billion month on month. This is the lowest level since September 2008. China is the third largest non-US owner of treasuries, but its holdings have declined by more than 10% since the beginning of 2025. In July 2025, China reduced its holdings by $25.7 billion, bringing the total down to $730.7 billion, marking the steepest reduction in nearly 2 years. China's holdings represent a 48% decrease from its peak of $1.32 trillion in 2013. This is not random selling. This is systematic rebalancing. The consistency of monthly reductions over multiple periods indicates structured approach to reducing treasury exposure while managing market impact and maintaining portfolio stability. Rather than conducting large-scale sales that might disrupt markets, Chinese reserve managers appear to be reducing reinvestment of maturing securities, allowing natural portfolio decline through non-renewal of positions. And here's what they're doing with that money. According to the People's Bank of China, China's gold reserves stood at 74.15 million ounces by the end of December 2025, an increase of 30,000 ounces compared with the previous month, marking the 14th consecutive month that the central bank has increased its gold reserves. The official valuation of these reserves approaches $370 billion, but the significant figure is in the tonnage. Analysts now suggest that China's actual gold reserves could be double the official figure, bringing these holdings close to parity with its remaining stockpile of US Treasuries. China is quietly changing from a lender into a competitor for safe haven assets. This is classic Stage 3 behavior. Reduce counterparty risk, increase monetary flexibility, and hold something that doesn't depend on another country's promise. The payment system China built to bypass the dollar. Next, payment rails. China's cross-border interbank payment system, CIPS, is an RMB settlement channel backed by the central bank designed to support cross-border yuan transactions and reduce dependence on offshore clearing routes. That's not a test system, it's a working rail. In 2024, total annual volume passing through CIPS rose 43% to 175.49 trillion yuan, equivalent to $24.45 trillion, driven by a 24% increase to 8.2 million transactions. Both volume and the number of transactions have more than tripled since 2020. As of June 2025, CIPS has 176 direct participants and 1,514 indirect participants. Among indirect participants, 1,102 are from Asia, including 563 in mainland China, 261 from Europe, 61 from Africa, 34 from North America, 34 from South America, and 22 from Oceania. CIPS participants are located in 121 countries and regions around the world. Business covers more than 4,900 banking institutions in 189 countries and regions. Now look at the adoption rate. By March 2024, over half, 52.9%, of China's own cross-border payments were settled in RMB via CIPS, surpassing the US dollar's 42.8%. BRICS nations announced they would increase the share of internal trade settled in local currencies from 35% to 50%. Intra-BRICS trade is already 50% RMB-based. Brazil conducted 40% of its trade with China in RMB in 2024, up from 95% in dollars in 2023. CIPS doesn't have to replace SWIFT globally to matter. It only needs to grow enough to serve as a fallback and a negotiating chip, and that's exactly what's happening. The digital yuan weapon. Most people don't understand. Now look at the digital yuan. The digital yuan doesn't need to become the world's money to matter. It just needs to scale enough to prove a concept that a major economy can build modern payment rails with different rules and can expand them quickly if it chooses. By the end of November 2025, the digital yuan had processed more than 3.4 billion transactions, worth roughly 16.7 trillion renminbi, about $2.3 trillion. That represents a more than 800% increase from 2023. Digital payments in China have reached a transaction value of about $10 trillion in 2025. The digital yuan pilot program now has over 225 million personal digital wallets as of 2025. In September 2025, China opened a digital yuan international operations center in Shanghai, featuring platforms for cross-border payments, blockchain technology, and digital assets. The center focuses on building and managing digital yuan cross-border and blockchain infrastructures to promote connectivity with domestic and foreign financial systems. And on January 1, 2026, a new digital yuan framework took effect, allowing commercial banks to pay interest on digital currency holdings. The digital yuan transitioned from digital cash to digital deposit money. This is China absorbing the appealing functions of stablecoins, such as speed, programmability, and real-time settlement within a sovereign and tightly regulated framework. Project M-Bridge transaction volume has surged to $55.49 billion, a 2,500-fold increase over early 2022 pilots, with the digital yuan making up over 95% of total settlement volume. China, Hong Kong, Thailand, and the United Arab Emirates are currently evaluating M-Bridge to facilitate cross-border payments. These transactions are completed in seconds and are 98% more cost-effective than the SWIFT system. Zoom out, and the Stage 3 behavior becomes visible. Encourage more overseas yuan usage, expand settlement corridors, deepen swap lines, and reduce over-reliance on any single foreign rail. That's not a conspiracy. That's a policy posture, and it fits the pattern. Where the $8 trillion number comes from. So where does the $8 trillion move come from? It's not a single line item. It's an attempt to add up multiple buckets. Reserve shifts, reduced exposure to certain Western assets, changes in trade settlement behavior, growth of alternative payment infrastructure, and multi-year strategic investment commitments. You can argue about the exact number, and you should, but the more important question is intent. Is this just portfolio diversification, or is it preparation for a world where finance is a battleground? Now, we hit the claim that turns this from interesting to terrifying in the online narrative. The idea that China issued a blanket order in November 2023 for state-owned enterprises to divest from Western markets within 3 years, implying a deadline around late 2026, and forced liquidation of trillions. I can't verify a public reliable primary source confirmation of a directive at that scale. Many versions trace back to commentary and reposts rather than official documentation. Here's why that matters. A real forced divestment order would be an unmistakable Stage 3 alarm bell because it would put a political timer on exposure reduction. Without verification, it's dangerous to build your entire worldview around it. But even without that claim, the repositioning story is still real. Reduced reported Treasury exposure, alternative settlement rails growing, digital payments scaling, and policy nudges toward more UN usage overseas. This is the part most people misunderstand. Stage 3 does not require a single dramatic announcement. Stage 3 is a posture. It's the accumulation of options. And when you have options, you can withstand pressure or apply pressure in ways you couldn't before. What Stage 4 would look like if it arrives. So what would Stage 4 look like if it ever arrived? Not prophecy, scenario. A menu of levers that could be pulled if leadership decided the trade-offs were worth it. Lever 1 is financial tightening through market stress. If a major player accelerates selling in sensitive markets, yields can rise, liquidity can tighten, and policymakers can be forced into ugly trade-offs. In the US case, higher yields raise refinancing costs and tighten conditions across housing, business investment, and equity valuations. The Fed can respond, but responses have second-order effects. Important nuance. Large sellers also hurt themselves if they push prices down too fast. And global investors react too. That's why this lever is more realistic as sustained pressure than a one-day nuclear sale. Lever 2 is targeted supply chain disruption. The most powerful version is not shut everything down because that unites everyone against you. The powerful version is selective friction. Export licenses, quality inspections, environmental reviews, customs delays, prioritization of domestic demand. Each one looks bureaucratic. Together, they create shortages, force inventories to rise, and pressure margins. And because critical components sit deep inside thousands of products, semiconductors, pharmaceutical inputs, battery materials, precision manufacturing, selective friction doesn't have to be dramatic to be painful. Lever 3 is offering the alternative system. This is what makes economic coercion more effective than military coercion. Deny, then offer a substitute on your terms. Want reliable supply? Settle in our currency. Want stable payment rails? Use our network. Want financing? Here are our terms. None of this needs to replace the dollar globally to matter. It only needs to capture enough marginal trade to weaken confidence and create a self-reinforcing shift during a crisis. The 3 lies that get people destroyed. Now here are the 3 comfortable lies that get people wiped out because they confuse today with forever. Lie 1. Mutual dependence prevents conflict. No. Mutual dependence creates incentives for stability until it creates leverage for coercion. Interdependence can reduce conflict, but it can also become the most efficient weapon available when leaders decide conflict is worth the cost. Lie 2. The dollar is too big to fail. Reserve currency status is not a law of physics. It's a social contract built on trust, market depth, legal stability, and a credible commitment not to abuse the rails. When the dollar system is used as a tool of sanctions, it is powerful, and it also motivates alternatives. That doesn't mean the dollar collapses tomorrow. It means the world has a reason to build an escape hatch. Lie 3. America can respond quickly. In some domains, yes. In industrial capacity and complex supply chains, no. Building fabs, rebuilding pharmaceutical inputs, expanding rare earth processing, and recreating whole categories of manufacturing is measured in years. Military strength doesn't solve missing components. Innovation doesn't help if you can't scale inputs. And debt doesn't feel like a problem until the cost of debt resets. How to position without becoming a doomer. So what do you do with this without turning into a doomer who sees collapse in every headline? You do what smart risk managers do. You separate certainty from probability and probability from impact. You build a plan that doesn't require a single prediction to be perfectly right. Here's a practical way to think about it. Instead of asking, will Stage 4 happen in 2026? Ask, what would I wish I had done if a major shock happened in the next 2 years? Then do the parts of that answer that are sensible even if no shock happens. That's what resilient positioning looks like. First, respect that the next few years are likely to be more volatile than the previous decade, because finance has become more political. Trade actions, export controls, sanctions, and industrial policy are now normal tools, not rare exceptions. Volatility clusters around those tools. Second, identify your fragilities. Which businesses, sectors, or assets you own depend on single-country supply chains, fragile trade routes, or easy global liquidity. You don't have to panic sell everything, but you do have to know what you own and what would happen if friction increases. Third, look for beneficiaries of de-risking. When the world becomes less trusting, the winners are usually the companies that enable redundancy. Domestic manufacturing, industrial automation, grid and energy infrastructure, logistics resilience, cybersecurity, and critical minerals processing. The regime shift creates new boring winners because the world starts paying for resilience the way it used to pay for efficiency. Fourth, diversify your assumptions. Don't anchor your entire future on a single base case like rates fall, the dollar dominates forever, or China will never risk its export model. Build optionality, quality balance sheets, real cash flow, pricing power, and diversification across geographies where it makes sense for your risk profile. Fifth, watch signals instead of headlines. If you want a real dashboard, pay attention to the trend in reported Treasury holdings, the growth of alternative settlement rails like CIPS, policy nudges toward more UN usage overseas, the cadence of export controls and licensing rules, and whether non-dollar settlement expands in specific trade corridors. Those are slow-moving indicators that tell you whether Stage 3 is deepening, and watch the language shift. When executives start saying dual sourcing, supplier redundancy, strategic inventory, and reshoring, not as a PR line but as a margin protection plan, that's the real-world confirmation that the regime has changed. The honest conclusion: nobody wants to hear. Let's bring this back to the central claim you heard at the start. China moved $8 trillion and Western markets will be destroyed. The honest version is China is building options and reducing vulnerabilities. And some of those moves are visible in official Treasury data, growth of payment rails, digital yuan scaling, and policy nudges toward overseas yuan usage. The extreme doom by 2026 framing leans on unverified assumptions and ignores constraints and trade-offs. But the pattern recognition is still worth taking seriously because the direction of travel is clear. The financial world is becoming more strategic. Because if Stage 4 ever comes, it won't announce itself as Stage 4. It will arrive as a routine market move, a temporary export control, a sudden spike in yields, a supply glitch that becomes a shortage, a payment bottleneck that becomes a political crisis. And by the time the crowd agrees it's a pattern, the repricing has already happened. So here's the question that matters. Are you positioned as if the world will stay perfectly smooth, perfectly globalized, perfectly predictable? Or are you positioned as if the world is becoming more fragmented, more strategic, and more prone to shocks? That choice, the way you build your portfolio, the way you build your business, the way you manage risk, determines whether a shock is a headline you watch or a wave that takes you out. None of this is financial advice. It's scenario planning. Use it to ask better questions, not to bet your life on a single timeline. Remember, the goal isn't to be right about one date. The goal is to not be fragile. If the world stays calm, you still own quality and you still compound. If the world gets rough, you're not forced to sell at the worst possible time. That's how you survive and still win. If this video opened your eyes, if this changed how you see what's happening, you need to subscribe right now because the pattern is absolute. The mathematics are absolute. Stage 3 is already in progress. Stage 4 is coming. The only question is whether you'll be ready when it does.